All right, what's up, guys? I hope you're doing well. Kind of just wanted to go over some of the consumer credit and housing data from this past version of the Monetary Policy Report, published this past February. I believe it was the 25th. And also saw some interesting things with mortgage rate splits, which will be interesting to play out, and we'll get to in a second. So pretty much, financing has been generally available to support the gains of consumer credit. This isn't very much of a surprise considering all of the like not just the government transfer payments, but the whole accommodative kind of monetary policy that we've had for the past while, especially with consumer credit and the past few years with the pandemic and everything. I mean, people still need to buy goods, and a lot of people weren't working and other things. But regardless, consumer credit flows are up. So as a result, financing conditions are now largely accommodative for borrowers with high credit scores. I think it's important to make that distinction. Though lending standards and terms remain somewhat tighter than pre-pandemic levels for borrowers with low credit scores. Another distinction that's made. And this can be shown more with the delinquency rates for non-prime auto and credit card borrowers remained well below pre-pandemic levels, likely stemming from forbearance programs and fiscal support. So, I mean, of course, the delinquency rates won't be as high when you literally force people to make it impossible for them to actually default or whatever. So there's that. And when the government comes in and helps, so that's a thing. But also thought it was pretty interesting. And I've heard a few comments on I think both the Bigger Pockets podcast and the Jason Hartman on his podcast in terms of real estate. And they're talking about the housing market, on how you're having a bunch of most of the people that are borrowing money into this bubble, at least from what I remember, have been more of your investor types. It's not so much the subprime borrowers. It's not that you have people who can't pay the mortgages buying it. You have people who are coming in and buying them as like investment properties or whatever. Completely different. Back on the consumer credit flows. So you see here, this is keep in mind these are consumer credit flows, and this is a monthly rate in billions of dollars, where you have zero here, positive is above the axis, and negative is below. Credit cards is this dark blue with a dot in the middle. At first, I thought it was something wrong with my screen with the dot in there, but I just couldn't. I don't see why dark blue is such a problem. They use it before where they don't make the distinction, but whatever. Everything is positive for the past fiscal year, so 2021, where you have auto loans with the light blue and the green, the student loans, where student loans are the highest. Not a big surprise. I mean, student loans, as you can see, never went negative since 2008, or at least not that can be easily visible. Auto loans had their spout, but have been positive, it seems, since 2010-ish or 2011. I'm assuming it's like, I don't know if this bar is 2011, so this must be 2010, and so the ticks are just to kind of differentiate between the bars. So yeah, there's that. And then, yeah, auto loans are up, obviously, especially with cars being so expensive nowadays. But more on construction of new housing and such. So residential investment is well above pre-pandemic levels, but fell back somewhat last year as construction was limited by persistent bottlenecks that led to material shortages. If you want to look more into this, a good person to look up is the Uneducated Economist on YouTube. Whenever I want to look into specifically like commodities or mostly building materials, I always look at his channel. I think it's Simon Karen is his last name, or Karen's his last name, but yeah. In recent months, the sector has shown signs of a rebound as single-family permits have risen steadily, which we see down here, with the permits being this blue line, and then single family starts are this kind of black line that follows it, right? One of the things that I thought was pretty interesting was just seeing how much it was decreasing since 2006 or at least a relatively rapid rate, I'd say, relative to the entire graph. So maybe that could be thought of as an indicator as a severe decline in single family starts, maybe coming into a major real estate crash. Maybe. I haven't really thought about it, but that's the initial thoughts, just looking purely at the graph itself. It could be one thing that it implies, at least, but I don't know, maybe not. So you see a steady uptrend, a huge dip in 2020, big surprise. You can see how that compares to multifamily. Multifamily starts, that's going to be mostly your real estate developers and major investors, or just investors, I guess. So they pretty much don't see much of a volatility depending on like recessions and stuff, because those are typically your higher net worth individuals, or they have a lot more available like financing and stuff. So at least that's what comes to mind at the moment. Could be wrong, but that's what comes to mind for me. And now housing demand. So demand for housing surged earlier during the pandemic and has remained strong, with home sales well above levels seen in the years before the pandemic, despite very tight inventory for homes available for sale. You see down here in this graph. So we have new home sales following an exit. So new home sales is this black line on the bottom, existing on the top, and you can see they have like the same trend. So it's like, which makes sense because you're still buying a home. It's just whether or not it's a new construction or not. And there's also some differences between how they're measured a bit. So new home sales include only single family sales and extend through December of 2021, while existing home sales include also condo and co-op sales. So that could be the difference in shift. I didn't see anything about the degree in which the condos or the co-ops play into that, so it could be different. Okay, so this surge in demand is likely due to a combination of factors, including increased work from home arrangements, shifts away from other types of consumer spending, such as travel and leisure, and mortgage rates that remain low despite notable recent increases, which was the reason I made the title as such with the mortgage rates, because we come down here and we see here's 2020, and then it seems like we hit 2021, and then just like a rocket going up, with like not even like a very distinct wobble. Like you don't see any, like, not that it's a stock chart, but looking at like technical analysis and stuff, where you have it's it seems like it's going through an upswing. So who knows how far it goes, because it doesn't seem to be rolling over. But this also extends through February 17th. So about 3 weeks ago or so, somewhere in there, about 3 weeks, at least as of this video. So yeah, it could. There's almost reaching 4%. That's why, like, I'm rather glad I talked to my my parents, because specifically my dad, because I was telling him, is like, you might want to go try to refinance the house, dude, because he'd been doing really well with like his credit score and all of his other stuff. He's been like, he got a promotion and he was doing well financially, at least compared to where he was before. And I was like, try to refinance and get that rate lower. And he actually listened. And he got somewhere down in here, which hopefully a lot of people did, especially if it's a fixed rate mortgage, because that would have been really helpful. But the problem with this, with the rates being this low is the prices go up. I guess kind of like bonds. At least that's what pops in my head. I don't think there's a distinct correlation besides just like the interest rates, because I guess you could argue there's similar forces between them. I mean, with the Federal Reserve having influence over the short-term rates and stuff like that. Whereas your mortgage, 30 years is a long time compared to like a 5-year note or even just like a couple months with some of the bills that they give for treasuries. So this kind of manifests down here where, okay, see if I can get these on the same. You can see these at the same time. I don't know if I can zoom out enough. There's 100%. Sort of. So basically my point is, you see with 23, with the real prices of existing single family homes in 2020, right, is when they really start to take off, which is right when mortgage rates hit kind of a bottom here. And so that's really the point. Also notice that this top graph, I'll zoom back in. I don't know how hard that is for you guys to see. But this top graph goes to February 17, 2022, whereas this one doesn't give an end date, it looks. But the last year is 2021, so it shifted back. Anyways, so you see this, we'll call it, I don't know if it wouldn't be called an inflection point, but at the time when the slope has a significant change, and so you have a change in this derivative and everything, going straight up, you have a definite break in that trend to the upside whenever this hits a bottom. So I'm wondering, maybe in the next monetary policy report, if we see mortgage rates continue to go up, whether or not we'll see this kind of flat line or even roll over, and maybe housing prices go down for single family houses, which you can see maybe starting to happen here in late 2021, but there's not enough time to really, because I mean that point's like right here, so maybe that's what's already starting to happen. But be interesting to see, to get some actual, let's see, according to the data from Zillow, national house prices rose almost 20% last year. Moreover, strong house price growth has been widespread across the United States, as nearly 80% of metropolitan areas experienced annual house price increases of at least 10%. Well, home prices are up. I bet you the CPI doesn't say that for homeowners equivalent rent or whatever it is. There's owners equivalent rent or whatever they have their data point is named, whatever they call it. It seems to change all the time. So yeah, that's for consumer credit and stuff. Also, maybe if you want to compare it to the CPI and see the owner's equivalent rent, I did write a post about that where I actually attached the PDF that from the Bureau of Economic Analysis, I believe, that actually posts the CPI, that actually does like the study and the data. So that's on the website and everything else if you're interested in that. So that's all I got for this video. We'll continue with the monetary policy report at some other time. So I hope you guys have a good night. And